Your P&L says you made money, but your bank account says you're out of cash. And this happens all the time. I've watched companies with $20 million in revenue worry about their $500,000 payroll going through their account every 2 weeks. And I've also seen companies with as much as $20 million in EBITDA wake up to negative free cash flow. Negative. And nobody in the room saw it coming. So I'm going to show you exactly how that happens, and the 4 places where your cash gets lost between what your P&L says you earned and what your business actually has in cash to spend. I call it the cash visibility framework. I spent more than 15 years putting together commercial financing for mid-market companies, close to $500 million of deals. And the pattern almost never changes. Profitable companies walk into covenant breaches they didn't even know they had agreed to because nobody at the top connected profitability to solvency and solvency to cash flow. And here's what the data confirms. Industry research consistently shows that in mid-market bankruptcies, working capital expansion silently precedes the crisis by 12 to 18 months. All the while, the P&L still looks fine, the numbers get signed off on, and the cash runs out the door anyway. So by the time the bank notices, they're sending you breach letters and adding you to their watch list, which means you've lost your negotiating leverage, and all goes downhill from there. The cash visibility framework has 4 letters. That's 4 places where your cash gets lost. C is for cash conversion. That's how fast your earnings actually turn into cash and how the working capital cycle of your business actually speeds that up or strangles it. A is for activities. Those are the 3 sections in your cash flow statement. You're operating, you're investing, and you're financing. Every dollar that moves in or out of your business shows up in one of those 3 categories, and most CEOs can't tell you which one is bleeding for them. S is for seniority. That's the pecking order your cash has to follow once it's generated. Government first, senior secured creditor second, subordinated debt third, trade and payroll fourth, equity last. Now, most CEOs deploy cash before they understand what's already spoken for, and that's the problem. And then finally, H is for horizon. That's how far ahead you can actually see your cash position. Not days, not weeks, months out. Stress tested against your downside with backup financing lined up before you need it, not when you're scrambling to make payroll because your largest client hasn't paid you yet. 4 letters, 4 gaps, and any one of them can put a healthy, growing company in crisis, let alone all 4. Let's go. The first gap is the speed at which your earnings actually become cash that you can deploy. And the mechanic that drives that speed is called the cash conversion cycle. 3 numbers control it: DSO, DIO, and DPO. DSO is days sales outstanding. That's how long it takes you to collect after a sale. Every day that number goes up, the more cash gets trapped inside your receivable. Next, you've got DIO, or days inventory outstanding. That's how long your cash sits on a shelf before it becomes a sale. And every day that number increases, more capital is locked into product that hasn't moved yet. And then finally, days payable outstanding, or DPO. That's how long you take to pay your suppliers. And this one runs in reverse. Extending DPO actually keeps cash inside your business longer. The cash conversion cycle is DSO plus DIO minus DPO. And of course, the smaller the number, the faster the cash moves through your business. And the larger it gets, the more your reported profit is sitting somewhere on the balance sheet instead of in your bank account. And here's the practical implication. This is the part that actually changes how sharp strategic operators think about working capital. On a $500,000 revenue base, reducing DSO from 90 days to 60 days injects about $40,000 of immediate working capital into your business. No new clients, no additional sales, just a structural adjustment for how fast you collect. $40,000, no new revenue. Now, scale that to $20 million in revenue. That same 30-day improvement in collections is a whopping $1.6 million in working capital release. Already in your business, just trapped. So here's a test you can run on your cash conversion cycle. Can you tell me your DSO, your DIO, and your DPO? And can you tell me your cash conversion cycle and which way each of the components has been trending over the last 12 months? Because if you can't, you really have no visibility into where the gap is between your profit that you've reported on the P&L and the cash that's hiding in your business. The second gap is reading where cash is actually moving inside your business. And it lives inside one of 3 sections on your cash flow statement. The first section is operating activities. That's the cash your business actually produced from running. This is the section where your EBITDA gets reconciled to cash. Working capital movements also show up here. taxes paid show up here. And if your business is healthy, this is where the bulk of your cash is generated. The second section is investing activities. That's your CapEx, your acquisitions, your divestitures. This is what your business is spending to maintain itself and to grow. Here you've got maintenance CapEx that keeps your lights on, you've got growth CapEx that builds the future, you've got acquisitions that consume cash, and you've got asset sales that generate cash. The third section is financing activities. That's where you have your debt service, your debt raises, your equity raises, your dividends, your distributions. This is the cash conversation between your business and its capital providers. Now, most CEOs only look at the bottom of their P&L, their net income, their EBITDA, sometimes free cash flow as a single number. They do not read all three sections of the cash flow statement against each other. And that's exactly the gap that lets a record EBITDA year end in negative real free cash flow. Let me show you the math. Take company A, $20 million in EBITDA. Best year ever. Board is thrilled, the CEO is happy. Now read the activities. In operating activities, receivables stretched and inventory swelled during the growth year. And combined, that's about $8 million of working capital expansion. Take $3 more millions in cash taxes that cleared, and your EBITDA of $20 million turns into operating cash flow of $9 million. Now move to investing activities. That's where you find $5 million of upgrade CapEx to keep the infrastructure running. Keep in mind the business didn't even add growth CapEx this year. This is just the cost of standing still. And then move on to financing activities, where you find $5 more million in principal repayments on the term debt that the business is carrying. $9 million in operating cash flow, $10 million out across investing and financing. That's a negative $1 million in free cash flow after a record EBITDA year. So the lesson here is that EBITDA is ultimately just a promise. It's operating activities that tell you what you got delivered. And then it's investing and financing that tell you what got taken. And the three sections together tell you whether the business actually generated cash or if it devoured it. So here's the test that you can run on activities inside your own business. Can you tell me what each of the three sections of your cash flow statement looked like last month, and then which direction they were moving? Because if you can't, you're reading less than half of your business. And by the way, if this is useful, subscribe, because I break down topics like this every week for CEOs and executive leaders. The next gap in the cash framework is S for seniority. This one catches even the most sophisticated CEOs. Here's how it goes. As your cash gets produced by the business, it doesn't flow wherever you want it to flow. It must flow in a particular order, and that order is set by the law and by contract, not by your priority. The pecking order is pretty much fixed. First, you've got government taking its share with your income taxes, your payroll tax, your sales tax. These are non-negotiable, non-deferrable past a certain point, and definitely not subject to your discretion. Second, you've got your senior secured creditors. That's typically your primary bank lender, almost always with a first priority security interest on your assets. This is where you find your term debt principal, your interest, your mandatory prepayments triggered by covenants. The bank does not wait. The bank gets paid before equity sees a dollar. Third, you've got subordinated debt and mezzanine financing, junior debt, seller paper from past acquisitions, earnouts in deferred form. Then fourth, you've got trade creditors and you've got payroll. Your suppliers, your vendors, your employees. Try running a business with unpaid staff and angry suppliers, then you find out fast where they actually sit on the priorities list, right? And then fifth and last, you've got equity. You've got your dividends, your distributions, your returns to shareholders. Everything left after every other priority has been satisfied. Now, most CEOs deploy cash without running that order through their head. They see a free cash flow number on a finance package and they assume that's available to spend. It's not. Free cash flow is not free. It has not yet paid for principal yet. It has not yet cleared committed obligations. And the moment a covenant tightens or a tax bill lands, the cash that looked deployable back in January is gone by April. Let me show you what happens when seniority isn't well understood. I once worked with a second-generation manufacturer, $35 million in revenue, strong business, strong family legacy, and they were projecting $50+ million in revenue for the next 5 years. They were going to keep funding all that aggressive expansion with debt because the projections justified it. But what they ignored was that the working capital pressure was building underneath. They were profitable every quarter, every single quarter, but they were bleeding cash because the cash conversion cycle had silently expanded for the past 2 years and nobody was watching it. It only took a few poor quarters to compound the problem, and by the time it surfaced in the numbers, the covenants were already breached and the cash was gone. The bank, sitting on senior secured priority, called the debt, and the company had to sell assets to recover almost $12 million for the bank. Trade creditors lost, equity was wiped out, the company collapsed into bankruptcy inside of 2 years. And that's not a startup story. That's a $35 million company that looked healthy on paper until cash flow and seniority caught up with it. So remember, if your free cash flow doesn't clear your debt service, you don't run your company. Your bank does. And here's a quick test that you can run on your own seniority. Could you tell me in order, in dollars, what your next 4 quarters of senior obligations looks like? Required tax payments, required debt principal, required interest, required covenant compliance triggers. Because if you can't, you're completely blind on every bit of cash flow that's already promised away in your business. Finally, the last step in the cash framework is H for horizon. Now, this gap shows you how far ahead you can actually see your cash position. And in mid-market companies, this is where most CEOs are quietly the most exposed. There are 3 horizons that matter, and you need all 3 running at the same time. The first horizon is the weekly rolling cash flow. That's your weekly granularity, your receipts and your disbursements line by line. This is the horizon that every PE-backed CEO has in front of them every Monday morning. It tells you whether the next week payroll will run, whether the next month's tax payment will get funded, whether the supplier check that goes out Thursday will land without issues. The second horizon is the 12 to 18 month rolling forecast. That's your monthly granularity with a 3-statement integrated model across your P&L, your balance sheet, your cash flow, projected forward, updated regularly, refreshed against your actual numbers every month. Most importantly, stress tested against the downside scenario with revenue compression by 15%, with loss of a key customer, with working capital squeeze, with capital shock costs layered in. The rolling forecast tells you when your next liquidity gap is coming, how much capital it will require, and how much time you will have to respond. Now, the third horizon is the 60-month strategic plan looking out 5 years. This is the horizon that your bank is already modeling against your file. Multi-year debt service capacity, long-term capital plan. That's the macro picture that decides whether they approve your next $5 million loan, whether they renew your current line of credit, whether they restructure you, or they exit you at the next renewal cycle. And running across all 3 of these horizons is something called contingency planning. Now, here's how I recommend you do that. You need backup financing options before you need them. You need a second bank relationship built while the first one is still happy, not when the first one gets nervous. You need a working capital revolver structured during a good year so it's available in a bad one. All these conversations are so easy to have when your numbers look healthy and almost impossible when they don't. And here's the difference that Horizon makes in practical terms. If you can see a cash flow constraint 6 months out, you have time. You can renegotiate supplier terms. You can tighten your collections. You can line up a credit line before you need it. If you only see the crisis looming 6 weeks out, you're reactive. Your options get expensive or they disappear entirely. And if you see it when it's already here, that's to say you're already in crisis. And crisis mode capital is the most expensive capital there is, assuming you even get any. Now, most mid-market CEOs are operating in weak money because the financial system they built for a $5 million company never upgraded for a $20 million one. And the test for your own horizon is this. Find out how many months of forward cash visibility you actually have right now. Not in your EBITDA forecast, in your cash, across 13 weeks, across 18 months, and across 5 years. Tell me, what's your backup financing plan when your largest customer pays 60 days late and your bank doesn't know yet? And what's your lost opportunity when the biggest acquisition shows up and you can't fund it comfortably because you can't see your future cash flow position? So that's the cash visibility framework. C for cash conversion, the cycle that decides how fast earnings become cash. A for activities, which is the 3 sections of your cash flow statement that show you where cash is actually moving. S for seniority, which is the pecking order that decides who gets paid first. And then H for horizon, which tells you how far ahead you can see across 13 weeks and 18 months and 5 years out, with contingency planning built in before a crisis hits. 4 letters, 4 gaps. Which one is quietly draining in your business right now? Drop a letter in the comments and let us know. Now, here's the bottom line. The cash visibility framework isn't about becoming a finance professional. It is about, however, owning your operating reality, because EBITDA is what the business earned. The cash conversion tells you how fast earnings turn to cash. Activities tell you where cash moves once it's in. Seniority tells you where it has to go. And horizon tells you when the next pressure point is coming. The CEOs who scale past this stop surviving cash and start engineering it. And if you're thinking this is exactly the kind of cash discipline you need to build inside your own company, that's exactly why I built the CEO Financial Intelligence Academy, an exclusive 12-month membership that comes with access to our 5-star curriculum, our coaching, and our community to help you stop making million-dollar decisions based on gut feelings. You'll get your CEO Finance Dashboard custom built by our team on your actual numbers from day one, with your past actuals and a fully controlled forecast for the next 5 years in one integrated picture, from your assumptions to your business valuation. You'll also have all 4 cash gaps solved in one go: cash conversion cycle, 3 statement activities, seniority waterfall, and a 5-year horizon that will all allow you to plan for the upside and the downside. You'll also be automatically enrolled in the next live cohort of the Academy. We run 4 times a year, 6 weeks live trainings with full recordings in case you missed a live session. You'll also get access to the CEO Finance Circle, which is our global community of CEOs working through the same decisions and challenges as you are. Bob Milner, for example, one of our alumni, came in worried about cash and missing acquisition opportunities. And 6 weeks later, he had improved cash flow by 11%. And he now has the frameworks and the system to anticipate financial pressure months before it arrives. If that sounds like something you need, the link is in the description. Pick whether you want your CEO dashboard refreshed once a year or updated monthly with your actuals, and you're in. And if you want the starting point right now, go and take the CEO Financial Intelligence Blind Spot Diagnostic on the Academy website. It's a 3-minute diagnostic with personalized feedback that tells you exactly where your blind spots are and what to do about them. That's also in the description right below. Also, while you're at it, join over 40,000 CEOs and executive leaders in my weekly newsletter. You'll get to upgrade your executive financial leadership, and you'll get my best infographics for free. Cash conversion cycle, financial statement red flags, debt seniority, rolling forecasts, you name it. It's all in the description. And if this video landed for you, the next one tackles the other side of this equation, which is the 5-step framework that PE-backed CEOs use to make every intelligent capital decision, and then the 5 places where most mid-market CEOs break it. I'll link it in the description.